So here are the strategy rules in order to trade the C to D extension move. Firstly, you want to identify the long-term direction. So in order to do this, you want to look at the higher time frame, things like the daily charts, the weekly charts, the monthly charts, and identify whether you should be buying or whether you should be selling. You know, are the bulls in control, are the bears in control? Once you've identified that, then you need to start drawing your trend lines in. Okay, so draw your counter trend lines in and draw your actual trend lines in the direction of the trend. Wait for a break of the counter trend line and then enter the market in the direction of the major trend. So here's what it looks like. So if the market is basically trending downwards, okay, so we expect the waves to be making lower lows and lower highs. You can see here the lows, nice low points here. These are the waves. The market's generally doing this. You should be looking for movements up, so the counter trend will be up. In other words, it will be a counter trend upwards against the downtrend move, and we'll be looking to sell as the trend breaks lower here in all these scenarios. Okay, so every time the market pulls back, we're looking to sell and sell up here and here. So here's an example of what this looks like. Okay, so you can see this is just a supporting line that as soon as it breaks, like here, we're looking to sell. You could actually have had an opportunity here as well, and here is another one. You sell, sell. Okay, so it's breaking this line, you sell. Every time it breaks this support line, you're basically looking to sell in the direction of the major trend. So once you know the direction, it's very, very simple. Wait for a closing price below this counter trend line, connect at least 2 points and have at least 3 green bars opposing the downtrend, and then look to sell it. Okay, so here's at least 3 green bars, closes below here, look to sell it. Again, this closes right here, look to sell it. The market goes lower, nice close below, look to sell. So eventually, you know, you could just continually do this until, you know, the trend breaks this downtrend, and then eventually you want to stop doing that. So basically, once you pick the direction, your goal is to draw, connect 2 points. Every time you close below that, look to sell the market, and until the trend line is broken, and then that's the end of the game. So you can just continually trade the market lower. If you add the Fibonacci to this will give you another edge to the market. Okay, it will give you another much higher probability setup. So if you factor in the Fibonacci indicator, what you'll avoid doing is getting in where the market is potentially going to turn. So what you don't know is, you know, where is the D, where should you be taking your profit, and that's going to be important. Okay, for an uptrend, again, you're looking for the opposite. You're looking for the counter trend line to break. So the counter trend line is basically lower, and you're looking for this lower break of a trend line there to buy, and here to buy. Okay, so it's just the opposite, same thing, but just the opposite. And if we look at an example again, nice, you're connecting a couple of points here. The market breaks, closes above, and you're looking to buy. Every time you close above, looking to buy. And as long as your stop is below this trend line and the market doesn't break this trend line, you will be able to stay in the market. You can see all of these are good opportunities. Another one there. I mean, you know, you can. This is a 60-minute chart. For example, this ends up being a big bar, and I would probably avoid this one. But if you use, say, like a 15-minute chart, okay, you probably would have got an entry somewhere there, a lot quicker. Okay, so definitely try and utilize the 15-minute chart to help you get into the market a bit quicker as well. So continually buy counter trend line breaks, okay, where you're connecting at least 2 points until the trend line is broken. So it's very easy to say sell the high, buy the low. We'll now tell you how we catch these moves in a step-by-step guide. So the first thing you want to do is identify the direction of the trend. And you can see from this chart that generally this market is making higher highs and higher lows. So in this case, the trend is up. Then you want to draw the trend line in. So here's what it looks like. Okay, so you're just connecting couple of points, and now you're looking for these areas here to act as support. And if you draw your Fibonacci in as well, that will also add to the confirmation. So here you want to apply the Fibonacci, identify the A, B, potential C and D, and target the D and stop behind the C. So if you have a look here, it's a much better looking chart because you can see the market here stopped, hit its D, pulled back, creates a C there. Here's your A, here's your C, and here's your D. And you can see, go down to the time frame. In other words, if you want to time your entry a little bit better, as we said, you can go down a time frame in order to find your entry criteria. So this is what it looks like on a 15-minute chart. Here's the 60-minute version. Here's the 15. So next, you want to draw your counter trend line in. Okay, draw your counter trend line in. If you get a break, now you know the direction you're looking to go. If we go backwards, just to remind you, here's our target up here. There's our D that's found on the 60-minute chart. Use the 60-minute D, but use the 15-minute chart to enter your trade. Basically, here's a close above that line, and now we should be looking to buy this market. Okay, that's the signal. We've got everything aligned. We've hit the Fibonacci, we've hit the trend line, and now we buy the market. Okay, and once you buy it, you're looking for the target to get hit, and look at that, perfectly hits the target and the market pulls back. So very, very simple strategy using multiple time frames to actually find your target. And actually what you end up with is a risk reward of 2.7 to 1. Okay, so in other words, you're making 2.7 times more than you're risking. And also, if you play this over infinite amount of times, you're going to have a high success ratio as well. So you're definitely going to have greater than 50%. And even if you had 50%, even if you only won half the time with a risk reward of higher than 1 to 1, you're always going to be with an upward equity curve. So in other words, even if you win half the time, if you're making 2.7 times more than what you risk when you win, then obviously you're going to make money. Okay, so with a stop just below these lows, you can see these were like tweezer bottoms here. Very nice formation on a trend line. Then you get the counter trend line break, and then it's a nice move up to the target. Okay, so that concludes this strategy. Very simple. Put it into practice and you'll find that it works really, really often. Okay, and if you don't have the Fibonacci indicator, of course, you know, you're more than welcome to inquire about purchasing it from us, but you don't need to have to do that. You can do all of these manually as well. And if you're trying to save costs, then certainly you can draw these in manually. You need to get them sort of color coordinated, and it does take a little bit of time to draw these all manually. But it's if you cannot afford to sort of buy the indicator, then certainly that's the way to do it. If you are interested in actually just getting the indicator, so it's you've got all your sorts A, B, C, D's drawn in for you with your targets, then you can just again contact Cameron at the email provided, or give us a call at the office and we'll show you how to access that. Okay, so next is one of my favorite plays. Okay, it's called the fade trade. And this actually is one of the most successful and high probability setups, and actually works very, very often in the markets. It is a bit more of an advanced strategy. So what I'm going to recommend is don't start trading this strategy with real money. Okay, make sure that you get your education up to high standard before you do this. But I just wanted to illustrate how it works, the rules for it, just so that you can see that there is a lot of things that you can do with the markets. And in fact, on our other courses, we actually provide you with 8 other strategies that you can use and utilize in this in the markets. But we want you to focus and learn some of these strategies first. This is you're getting 2 really good strategies in this course. Get to grips with them, and we do cover these in a lot more detail as well in the following course as well. Okay, so let's begin and to show you all the rules for the fade trade. So this strategy actually goes against the trend, but if you know what you're doing, which is why we said it's an advanced strategy, then going against the trend can be very, very lucrative, because you can get in with a very, very tight stop if you know where the market is about to turn. So here are the strategy rules. Firstly, you want to identify whether we are in an uptrend or a downtrend. Then you want to draw in your Fibonacci sequence in the direction of the trend. Look for the 80% setup. In other words, this is the trade strategy that will work 8 times out of 10, or 80% of the time. Find a candle formation at one of the 3 buy-sell levels, and then enter the market and place your stop and profit limits in. So let's explain how this works. So this setup actually often works, if you do it in the correct way, 90% of the time. 90% of the time you're going to get a pullback to the 38.2% Fibonacci level when you hit this D target up here. So let's look at the strategy and explain how this works. As we said, this strategy involves going against the trend. So as we mentioned earlier, when you draw in the Fibonacci sequence, the markets will tend to just pinpoint the turning point up here. In other words, the target often gets hit and then the market reverses. But how far back down does it go? Well, one of the things that we've identified is that 80% of the time we will pull back to this area here, the first red zone, which we call the 38.2% Fibonacci retracement, before going up higher to reach the next target. So if I draw this out for you, if it looks like this, we're looking to basically trade this to this, because 80% of the time you will get at least a 38.2% pullback before reaching the D target of the next move. So what we actually are trading here is the B to C, but only up to 38.2. All of the rest of this here could go, it could obviously go lower, but we're not interested in that. That is not where the high probability setup is. We are looking to trade just simply from here to the 38.2%. And obviously, when you're looking at a downtrend, it's going to be the opposite. So you hit the D target, and then we're looking for the pullback up to here at the 38.2. Of course, now the other type of setup, which is very, very similar, okay, and again very, very advanced, is sometimes the market will actually not pull back to its 38 immediately, start to rally and actually find resistance at one of these Fibonacci extensions, the 127 or the 118. Then eventually it will come back down to its 38. Just like we said before, 80% of the time you'll come back here before going up here. If, however, we go above the 127, then at that point the probability is that we're going to reach here and go beyond it, because the market is showing us incredible strength. But unless we go above the 127, you can always place your stop above there and expect the market to come here 8 times out of 10. Okay, I've done extensive back testing and this strategy is really, really solid and works. So if you always put your stop behind the 127, unless it's going to be one of those really fast, high speed markets, then the market will come back to at least its 38.2%. Okay, so our job is to find a setup to basically take advantage of that. We cover this in a lot of detail in the next courses, and that's going to be, you know, really, really key to understanding it. But what I wanted to show you is just an idea of how this works, because then you can start to think about, you know, different things that you can apply to the markets and how probable these things are. You know, if you had these setups, you know, very pinpointed, like, you know, with exactly the exact rules, what you need to enter the market, how to trade them, imagine winning 8 times out of 10. And you know, if you're trading up here, you know, you could end up sometimes risking that much to make this much. Sometimes I'm getting sort of 3-to-1 trades, 3-to-1 trades that win 8 times out of 10. Imagine that. 8 times out of 10 you win, and you make 3 times more than what you risk. That is phenomenal. Okay, and this is the power that you can actually have with this strategy. What we recommend is don't trade this blindly. If you want to practice this strategy, make sure that in the sort of sell zone or buy zone, okay, when it comes to sort of like fading it upwards, make sure you have like a candle formation like the ones that we covered earlier before taking the trade, or some sort of counter trend line break. So here's what it looks like. You can see here's the Fibonacci sequence, okay, the market going lower, and you can see the pullbacks that we're targeting are these areas here. Here's the 38, here's the 38, and this one is the 38 up there. Okay, so identify the shallow pullback, not to the 38.2. So if the market doesn't pull back to the 38.2, that's also very useful to us, because that's telling us that the market is very, very strongly bearish or strongly bullish. So what that tells us is that if the market's like that and not pulling back, then also you could take advantage of it and play aggressively with this with very tight stops, because the market is very, very fast. Look for rejection candles, okay, before entering the trade, and enter on break of rejection a candle high, stop loss below the low, and target the 38.2%. Okay, so what you're looking for example, here's a nice reversal bar, here's your target there, and this is a 60-minute chart. What I'd normally recommend is you go down to a 15-minute chart. So use the 60-minute C to D formations, but go to 15, because if you, for example, enter it there, it's way too late, and you're not going to make much there. Okay, so make sure that you go into a smaller time frame. 15 is what I'd recommend. And this one here is an example where you could have been taking this at the 127, nice rejection candle, and you can see eventually nice stop loss there. Okay, and the target is hit around 2-to-1 trade there. Okay, back to the 38. So this one is one of those examples where the market didn't go back to its 38. Eventually it actually went down to its 127. Nice rejection candle there, very nice entry. You buy it there, and nice target, 2-to-1 trade on that one.